In this lesson, we are going to review how businesses acquire their financing to start up and then to grow throughout their stages until they become larger businesses that employ numerous amounts of people. When a business first is started, either as a mom and pop business or buying an existing business, the funds used to acquire the small business can come from different sources. Usually they come from the buyers, their family, friends, in the forms of either loans or equity, or they could come from a loan from a bank. This is usually called Stage 0 to Stage 1 financing. As a business starts to grow, or as the business grows from its inception, whether it's a new venture or it's a business, an existing business that was purchased by new owners, as it begins to grow, it will need to acquire new forms of financing to support that growth. If you've ever watched the ABC show Shark Tank, investors and entrepreneurs get together in a round table, and entrepreneurs pitch their ideas to these investors. And usually these ideas are at what's referred to as Stage 2 financing. What Stage 2 financing normally refers to is the growth of business from that small entity to a larger entity that can handle increased sales volume and increased production. But in order to get here, a company needs to finance its investment in capital infrastructure, or simply capital. As you remember from chapters 1 and 2, and maybe from your accounting classes if you've had accounting, capital refers to plant and equipment. It doesn't refer to money. Capital is required for growing businesses because in order to increase production, businesses need more money to buy more machines and to hire more people. Production usually outpaces end user sales by about 6 months. So production needs to be all fronted by the manufacturer, the business owner. So in order to do that, they need money. Depending upon how Stage 0 and 1 were financed is really going to determine how Stage 2 is financed. Let me explain. If Stage 0, Stage 1 were financed predominantly with debt, when a business goes for Stage 2 financing, as part of the normal credit underwriting procedure, a company or a banker would look at what's known to as the debt to equity ratio, looking to see how much debt is in place, or to use a financial term, how much leverage the company has. The higher the debt to equity ratio is, the less likely a company is going to be in obtaining a loan. So, if a company cannot get a loan, what can they do in order to grow the business? The next step is to go and find an equity investor. An equity investor is someone who invests cash in a business in return for some ownership percentage in the business. They could also get what's known as a preferred return, which is some sort of interest rate on their money, plus a percentage of the profits. So, who would be a source of equity capital? Well, there's a couple of sources. First are what's referred to as angel investors. Angel investors are industry veterans who look for businesses, growing businesses in their former industries or current industries in which they can invest money in, but also can provide some sort of leadership and guidance. Typically, angel investors will invest up to $100,000. A second form of equity capital in stage 2 is what's known as investment banks or private capital companies. These are companies and funds that take in money from accredited individuals. We'll get into that the significance of the accredited individual definition in a few moments. They take in money from these accredited individuals and lend them out to growing businesses in the hopes of generating a return for themselves and for their investors. How do they generate a return? Well, they generate a return by selling the company or selling their stake in the company in a later financing stage at a profit. We'll get into that in a few moments. Other than these two sources, if a loan is not able to be obtained by a business, they can still go back to family and friends, but it's very rare to have family and friends that have the type of money to move a business in stage 2 move it into that growth stage. So they're really left with these two options. Now, let's get back to the term accredited investor. Accredited investor basically is anyone who has an income greater than $200,000 in 2 consecutive years, or assets that are greater than $1 million in net worth, not including the investor's primary home. Now, why is this important and why are we bringing this up, and how does it relate back to other areas of what we're studying? Well, we've talked about, or have you heard talked about numerous times, that the rich do not pay their fair share in taxes. Later on, we will do an analysis of taxes paid by income brackets and find out if this is true or not. But let's just go by the assumption that they don't pay their fair share. If they're not paying their share, then that means they have more than enough incomes to live on. And if they have more than enough, that means that they have an excess. What do they do with that excess? Well, one thing they could do is they could give it to charity, which many of them do. Or the second thing that they could do is they could invest in these private equity firms. Now, if you raise the tax levels on individuals making more than $200,000 a year, you are going to decrease their ability to give to both charity and to invest in these firms, which then turn around and provide funds for businesses to grow. How? Well, you're going to make that will mean that they don't have enough, or they wouldn't have as much to live off of. So if they're spending more on everyday expenses, then their discretionary incomes and their disposable incomes are going to be lowered after their necessities are paid for. So how are we going to account for that in the growth of businesses? If small to medium-sized enterprises, or what's referred to as SMEs, make up about 60 to 70% of all businesses, and as everyone, or as political leaders on both sides and both parties have mentioned, that small business growth is really the growth engine to entire economic growth. So if these companies don't have access to the capital that they need to grow, how is our economy going to grow at a faster rate than it has? Now, let's get back to that accredited investor definition. The accredited investor was designated in Rule 504 of the SEC, Rule 504, 505, 506 of the SEC's Regulation D. And you could look it up and find the specifics on it. But let's move now back to, if these accredited investors now have less disposable incomes, which means that they have less funds to invest, then we could follow that train of thought to say that these private equity firms have less funds to invest in the small to medium-sized enterprises, and they cannot grow. So, to summarize, when businesses go through their first and second stages of financing, this could come from a bank loan, or it could come from savings from family, friends, and the business buyer themselves. However, to get to this second stage, depending on how the first stage was financed, the only way a company could grow is through an infusion of equity capital, through the financial intermediaries that could bring that together. Now, Stage 3 financing could follow the same boat, but hopefully the people, or what the Stage 2 investors hope for, is to cash out sometime in Stage 3 or even in Stage 4, which potentially could be an IPO. Now, let's just say that you went and you bought a ice cream parlor, and that business was very successful. You financed the purchase of this existing ice cream parlor through your own savings, some loans from family and friends, and a bank loan. Now, this business is so successful, and you got a process or a product that's in demand, you want to open up a second location, grow your business. However, because of your first bank loan, your bank is hesitant to give you a loan for the second location, even though your first location is pretty successful. And this has become commonplace, especially since the passing of the Dodd-Frank Financial Reform Bill, and because banks are very skeptical about the future of business. They're very hesitant, and they're becoming risk averse. So the money to open that second location is not there, or may not be there. So where do you get that cash from? Well, you're going to need to find equity investors. And going to that second location, then to that third location, the fourth location, the fifth location, sixth location, so on and so forth, your chain of ice cream shops is going to become harder and harder to finance with debt capital. So what happens is you need to find someone that shares your vision, is not adverse to taking risks, and to put that money into you, or lend you that money, or give you that money, invest in you, so to speak, and your idea in order to grow that business. Now again, if people are paying more in taxes, they're going to have less money to invest. So if that money isn't there, you may not have this second location, this third location, this fourth, fifth, or sixth location. So if you don't have those locations, you don't also have the employees, the 1 to 3 employees, or however many you need to run this location. New additional jobs created for each one of these locations. So let's just say you need 3 employees to run this operation. If you can't expand to 6, there's 18 jobs that'll never be created. Now this is a very simplified scenario, but it's a real scenario. And 18 jobs may not sound like a lot, but it's a lot to 18 people that would be filling those jobs. Now multiply that by the thousands of small businesses. How many jobs can they create? True economic growth comes from mom and pop or micro businesses growing to small businesses, then to medium-sized businesses, then to eventually to large businesses. True economic growth does not come from bigger businesses, because when you get to a certain scale or certain size, it becomes harder for you to grow at faster rates. Just ask Microsoft. So, in summary, rich people provide funding for small businesses. When small businesses grow, they create jobs. When jobs are created, we could have increased spending, hence our circular flow model, and we could ultimately have economic growth. So in order to have all this, we need to then counter the argument for higher taxes for higher incomes.